Good morning, everybody. Today we are doing a webinar, Swap Till You Drop. We're going to talk about building a foundation for the 1031 exchange, so you can understand probably one of the best tax loopholes in our entire tax code. Just an incredible way to protect wealth from giving it away to Uncle Sam. So today we are talking to real estate investors. And we are talking to future real estate investors, anybody that is interested in figuring out how to protect more of their gains and making money in real estate. I want to introduce Debbie, who is our panelist today. Debbie Bannister has been in the real estate industry for 40 years, working in the loan industry, also in escrow. And for the last 20 years, she has been the vice president of Exchange Resources, Inc. She received the designation of Certified Exchange Specialist, and she works to consult and educate investors and the broader real estate community regarding 1031 tax-deferred exchanges. She also assists in structuring more complicated exchanges. She consults with lenders and other agencies, assisting them to understand the exchange the exchange process. Let's welcome Debbie. Hi, Debbie.
Hi, thank you for having me.
Yeah, thanks for being with us. Appreciate you being so generous with your time and spending some time to educate us today on the 1031 exchange. I'll very briefly introduce myself as well. I'm a licensed real estate broker with Keller Williams. I've been selling real estate for about 12 years now. Completed 1031 exchanges. I've helped clients complete 1031 exchanges. I've actually completed 1031 exchanges myself for my own investment properties. I've sold over $250 million in real estate in the last decade. And just have a passion for real estate. I truly believe it is the best path, hands down, to build generational wealth. So Debbie, to start us off, you told me a story once that I think a lot of times when people think of 1031 exchanges, they exclusively think of it as a tax planning tool, which of course it is. You shared with me a great story once about how one of your clients actually used it for, let's call it legacy planning. To kind of plan for, when she passed from this world and was leaving some things to her kids. Can you share that story as to kind of start us off?
It would be my pleasure. I had a client several years back that she was in her 90s. She was like 95. And she was amazing. She did a lot of homework online and learned about exchanges. And she learned it properly. Sometimes I get people coming to me what they learn online and it's all messed up. But she got it. And she had 3 apartment complexes in a cul-de-sac. And each of them were exactly the same, and she had 3 grown kids. So she wanted to clean up her real estate portfolio because these apartment complexes she's had for a long time and really kept them status quo. So they were not in great shape, and she didn't want her kids to inherit a nightmare. So what she did is she took each of her kids, she had 3 properties, she said, kid A, I'm going to sell this property, I'm going to be the owner, I'm going to be the seller, I'm going to be the buyer, but you're going to manage what I buy. And I want you to pick exactly what you would like to inherit. So this person took that money and figured out what they wanted, and this is what they want, what they can manage and what they can inherit. Kid 2 did the same thing, kid 3 did the same thing. So it took about 1.5 years to go through all this. And in the end, it was like such an amazing process because literally 6 months after we were done, she actually died. And this woman became like, I loved it. Every day I got to talk to her for 1.5 years and I loved it. And the amazing thing is each of the grown kids, they were all in their 60s. I talked to them all one by one, and it was amazing because not only did they pick what they wanted to inherit, they were paid property management fees in the meanwhile until the mom died. And then they got this stepped up in basis. So that means that they sold this property. That means at the time of death, they get a valuation. So say it's valued at $2 million. And if they sold it for $2 million, then they would have no taxable event. So some of them sold out and got cash, other ones maintained and continued on. It was just an amazing thing how that happened. And I recommend estate planning with exchanges highly.
Yeah, that's great. I love the proactivity and the intentionality to actually plan ahead like that rather than just, hey, I'm passing away and my kids get my stuff. How is it going to be distributed? What a great way to kind of reallocate things and make sure that, that's a really cool story. I jumped the gun a little bit. I meant to say to our listeners today, Courtney, who's helping me to moderate, is going to go ahead and put a couple links in the chat and on Facebook. One, she's going to tag Debbie. So if you need to get a hold of Debbie for any exchange needs, 1031 questions, you can go ahead and reach out to her. She's also going to post our Calendly link, where if someone would like to schedule a 15 or 30-minute call with us, they're welcome to do so. And also, we have a link for our market update on the Orange County real estate market that goes out every 2 to 3 weeks. If you'd like to subscribe to that, Courtney will put that link both on Facebook and here in the Zoom chat. So as we get into the nitty gritty of 1031 exchanges, the goal really here is to lay a foundation. I always say when we do these webinars, we're going to assume that we're talking to a diverse group of people. There's going to be people that have never owned their first property. There's going to be people that have owned all kinds of properties, people that have done 1031 exchanges and want to get more into the intricacies. And then, of course, other ones that have, know nothing about 1031 exchanges. So we're going to try and kind of speak to the middle bottom of the class in this first session here. So could we kind of start out, Debbie, by just having you really describe what is a 1031 exchange?
I would love to. First of all, I'm going to say something that I want to define what is a 1031 exchange, but I want to start this by saying what is not a 1031 exchange. And that is, people have this idea that it's tax-free money. So a 1031 exchange is not a process to have tax-free money. It's actually tax-deferred. It's tax-deferred, so the deferral will follow the taxpayer. So bottom line, what is a 1031 exchange according to the code? It's the sale, it's the trade, if you will, of an investment property for another investment property. And as long as they buy basically equal or greater, then they have the premise for doing a 1031 exchange. So it's it has to apply to investment property. Okay.
Perfect. So logistically speaking, how does a 1031 exchange work? What exactly are you doing and accomplishing?
Okay. So from a 1031 exchange process, I'm going to do both sides for the investor and for the exchange process. So let's start with the investor. When a 1031 exchange, how it works is basically when they do sell that property according to the code, they can't have constructive receipt or control of those funds. Thus, that's why there's the need for a qualified intermediary, and that's what we are, a qualified intermediary. And according to the tax code, since they can't have this constructive receipt or control of these funds, when they hire the qualified intermediary, we prepare agreements and we actually get assigned into the transaction with the taxpayer. So now the taxpayer is the seller, and the seller identity and escrow will be Exchange Resources Inc., for example, the name of the QI, for the benefit of the acronym FOB, and then it would be Debbie Bannister. So we're together. And then that allows us to do our work for the taxpayer and making sure they have an exchange and do all the paperwork that we need to do. And also allows us to receive the proceeds at the close of the sale, because the client, as I mentioned, cannot have that control. So we take that money and have it set up in segregated tax bank accounts for each client that we work with. And then on the replacement property, we get signed into. But when regards to the exchange itself, what it really accomplishes is it allows the taxpayer to really reorganize what they have. It allows them to, if they have property that's not working for them, or property that's depreciated out, or property that they hate that type, that class of property, and they want to change the type, 1031 exchange allows them to reorganize, sell, buy something else, get into a different type of property, or maybe they have high loan debt and they want to reorganize that loan debt. And they can sell that property, maybe buy two properties, where they can spread that loan debt among the two properties, so as to perhaps over here they have one property with, say, worth $2 million, $1 million loan debt, $1 million cash, obviously. So, but they're always in the red. They never made enough money. They never really made money on their income property. So now the exchange allows them to reorganize by maybe selling and buying several smaller properties, putting smaller loan debts among all these properties, which would add up to that $1 million. and use the $1 million cash as offsetting, the rest of the value of the property, the equity. And some of the properties they can buy free and clear, some they can have with loan debt. But at the end of the day, that reorganization could allow them to finally have cash producing properties, which is amazing.
Got it. So you could take a highly appreciated asset and basically, I mean, can you use the word convert? Like, are you basically kind of converting the property into other?
It's basically a trade.
You're trading. Okay.
And the reason why we use that verbiage is because you're going to take everything for the sale property, the cost basis, all the economic factors that belong to that property, and we're going to move them into whatever you buy. So it's just being deferred. It's just being moved over. So we call it a trade due to the fact that that economic fact, excuse me, the cost basis gets moved over here. And if they bought multiple properties, that cost basis is prorated out and spread out between all the properties. And so it's just a way of reorganizing.
I love that. And it's interesting. I think a lot of people think about reorganizing their stock portfolios, right? They might say, oh, all of a sudden I'm too heavily weighted in technology because tech is so high right now. So they sell some tech and they buy some gold or, some other asset, right? And this is kind of the same idea where you say, hey, I want to trade out of my, commercial building into maybe a whole bunch of vacation rentals, or I want to move some money right outside of California and maybe I want to go invest in another state. And they can defer the tax of their theoretical gain on that property by moving it into another asset.
Absolutely. And it's beautiful that you're not stuck. It's right. Beautiful that and because people think that they're stuck. If they sell it, they're going to pay taxes. But this deferral, this 1031 allows them to do this and keep their properties at optimum performance if possible.
Yeah, perfect. So as a qualified intermediary, you had mentioned that if you sell a property and then, 1 penny of the funds from that property go into your own personal bank account as a seller, that gain is now taxable. But whatever you receive, but by using a qualified intermediary and going through a 1031 exchange, those funds, as long as they're reallocated, traded into a new building or some kind of new property, then those funds are not taxable. So as far as you at Exchange Resources, Debbie, are a qualified intermediary, you hold those funds to make sure that there's no constructive receipt, right? That the seller doesn't receive those funds. So tell me, as a qualified intermediary, how as a seller can I trust that those funds are protected, right, by this 1031 exchange company?
Perfect. That's a great question. Okay, so what's most important for anybody that you would think of wanting to work with as far as a qualified intermediary, we want to know there's a few things that need to be. For example, one, they have to, if they do not have this, walk away, have it set up where they have segregated escrow accounts for each of their clients, segregated from the company's funds, segregated from other clients. So you want to make sure that there's a clear line and everything's separate. You do not, maybe they're separate, segregated from the clients, but the monies are not separated. The company funds aren't separated. Not good. So that's essential. Number 2, E&O insurance and fidelity bond, essential. You want to make sure they have that. And sometimes there's smaller companies, mom and pop shops that can't, because they're extremely expensive because of all the bad things that happen in our world. So they may not have them. So you want to make sure that they have their those insurances, fidelity bond, E&O insurance. And the last thing I feel that's very important is that they have a history. How long have they been in business? What type of employees do they have working for them? Are they educated in regards to the exchange? Can they really help you? So like for us, in our company, we find it very essential. We have a trade organization that for us as qualified intermediaries, and we have a designation called an exchange certified exchange specialist. And that test is almost equivalent to taking the bar. It's very difficult. And so, but what it does is it makes sure that the employee, like I have this, and we have several employees that have this, that they absolutely know their craft. They know their business. They know what the code is about. They're forced to keep that designation. They're forced to keep with live education and different things. So that education, making sure you're working with good educated people on the QI side that understand exchanges, because a simple exchange could easily turn into a complicated mess. So you want to make sure that the QI has educated people that understand how to help in whatever situation.
Perfect. Okay, good. So tell me a little bit, Debbie, about the timelines, because I understand, of course, like anything related to the tax code, there's all kinds of rules and regulations you have to fit, in the box. So tell me a little bit about the timelines around an exchange.
So from the close of the sale escrow, we'll start the official clock that IRS gives the taxpayer to accomplish their exchange. So there's 2 clocks that start on that given day, the day after escrow closes. So the second clock is a total of 180 days, which is called the exchange period. And what that means is that they have that 180 days to buy, close escrow, and be done with their exchange. So sounds pretty easy, right? But the first clock is the first 45 days of that 180 are separated out, and that's called the identification period. So now they only have 45 days to identify what they will be buying, what they will be closing on, if after the 45 days have elapsed. So this is really an important, it's really important with this 45 days. Would you like me to go ahead and talk about some strategies with the
Yeah, why don't you tell us some, as far as that identification period, what would be some strategies to make sure your 1031 exchange is successful?
So I highly recommend that if it's possible, it doesn't ruin the deal, but if it's possible, to negotiate with the buyer of it's like if you presented an offer on your relinquish or sale property, to negotiate for maybe a little longer escrow period. So if they want a 30-day escrow, maybe go for 45. So what that does is it gives the taxpayer a little cushion of time so that they can be out there looking actively and presenting offers for the replacement property that they're looking for. And if they get an offer accepted and they're only buying one property, look what they've accomplished. They've gone in contract before escrow closes on what they're selling, so the clock hasn't started. They can get their inspections done hopefully right away. And so maybe what they can do, since if everything works out fine, they can close before the 45th day is up, and now they have what IRS calls a perfect exchange because they were able to close within that 45 days. They don't even have to identify. But if they don't, say it all falls apart, say it goes the other direction.
Right.
The benefit there is they still have a 45-day safety net that they started an escrow here, so that time didn't take away from the clock that will start ticking. So the 45 days is like a safety net, so they still have time to put it together.
Yeah, because I think the scary thing about going into a 1031 is, are you going to be able to identify what's called your upleg property within that 45-day period? Because if you can't identify, or if you identify something and then it sells to somebody else, you identified the wrong property, they took it off the market, your whole 1031 could fail, correct?
Exactly. So this is what I say. People call me up and they say, do I have to be in contract? Do I have to be in escrow, for my replacement property when I'm identifying? And you don't have to be, according to the code. But the code is also ridiculous, because if you can't close on what you identified, then you lost your exchange. So the strategy would be start early. Even if you go into contract before, like if knowing the market, like you, Jordan, you know the market and you're helping the seller sell a property, but this property will go really quick. So maybe they should put some energy in finding the replacement property and maybe going into contract and have a little longer escrow. And then that gives time to market this and get it closed and sold. So that way the sale can close even as little as a day before the purchase closes. Right. And that sounds maybe risky, but it may not be. It just matters the situation, and you, because of your expertise, you'll know how risky it is and if it can work out. As far as the way the market's going. So, but even that, maybe some people buy new construction and the house won't be done for like 8 months. So they'll wait 2 or 3 months after they got in contract on the new construction. And then they'll go ahead and have their house listed and then sell. And then by the time the clock starts ticking, there's enough time in that 180 for the house to be completed. So there's things they can do. So you can always go into contract anytime for a replacement property, but what's most important is the sale has to close before the purchase in this type of an exchange.
Got it. Yeah, and I think that being in a hot seller's market can make it where your property that you're looking to dispose of can move pretty darn quick, and then you may actually struggle to find that upleg property.
Absolutely.
Yeah, which kind of brings us to the possibility of a reverse exchange, but we're not going to get into that at all today because it's more a little bit more convoluted. But I'm going to put a teaser alert out there that we will do a swap till you drop part 2, where we will be getting more into the nitty gritty of some more isolated, issues within the context of 1031 exchanges. I will be kind of pitching a little bit more detail and timing of that toward the end. So as we go down this path of identifying the upleg property to replace the property that you've sold, what kind of properties can you identify? In other words, are all types of real estate considered equal? Like, could I sell, let's say, an industrial building and buy a single family house? Could I buy raw land? Could I buy an apartment building? What can I trade?
Well, I love this question. So this is in the tax code, this is referred to as like-kind property. So
Okay.
basically, what is like-kind property? And so the bottom line to this is that as long as it's real estate, anywhere in the US, then it qualifies for an exchange. It's all about not what the property is, but how the property will be used by the taxpayer. So as long as if it's a single family investment home, it needs to be a rental. The code specifies that as long as it's investment property, i.e. rental, or property used for the productive use of a trade or a business, then it qualifies for an exchange. So that shows you the world is your oyster. You can buy anything you want as long as it's, as you said, real estate and used for investment purposes or a trade or a business.
I see. So then and you specifically mentioned that does include vacant land.
Does absolutely include vacant land, because what would disqualify property from exchange is personal use, like, second home, primary residence. So IRS has taken a stance that if you've got vacant land, you're not using it personally. So
Right.
It went into the investment bucket, and it totally is investment property.
Perfect. And you said the funds do have to stay within the US. You cannot go offshore, correct?
Absolutely. You've got to stay within the US.
What about the territories?
So very good. So territories have to sign a certain tax treaty every year for them to participate in the 1031. The only territory that cooperates and signs the tax treaty is US Virgin Islands. So Guam, Puerto Rico, they don't cooperate. But you don't know. Every year could be different, but so far they've been on their stance for quite a while, Guam and Puerto Rico.
Perfect. So tell me a little bit about multiple properties. So in other words, can I do a 1031 exchange where I'm selling, let's say, I don't know, let's say I have a really expensive duplex, in Newport Beach. Could I sell that and buy, let's say, multiple properties across Texas? Or the opposite, could I sell multiple properties at the same time and 1031 exchange into a single asset? How does that work?
Well, this is where the fun starts, because it works well, but there's a lot of work to it. So if you're selling, let's start with selling one large asset and going into smaller assets, and then we'll go the reverse.
Okay.
So let's just say we sold something for $3 million in a duplex in Newport Beach or something. I know it would be way more, but let's just make up a number. And so that allows the taxpayer to use that 180 days. This is when the 180 days are great. They have to work really hard to get in contract. And this is where a longer escrow for the sale property really would be a blessing, because they need to be out there looking whatever state they're going to, presenting offers, getting a contract, presenting offers, getting a contract. And that way, when it comes time to identify, they can identify whatever properties are a fact, thus a hope, minimizing something that could negatively happen, like that could make their exchange fall apart. So, and multiple properties are pretty cool, because as I started off earlier, when you're doing an exchange, if you have a loan on a property, you have to replace that loan debt with a new loan on whatever you're buying. So say you had a higher loan over here. So maybe you had $1 million loan, and so we sold for $3 million after fees. So now you got $2 million cash and $1 million loan. So you can go out there and buy as many properties, spread it out, buy some free and clear, buy some with lower loan debt, spread it all out. And maybe you got 10 properties with $100,000 loan debt on it, or whatever you want to do. And at the end of the day, we add up the total acquisition of what they're buying, and the total loan debt and how the cash was spread out. And as long as that is equal or greater to that net sales price, the sales price after the cost of, the cost of sale, then they have a beautiful exchange. Now, what will happen is maybe they have several properties they're selling to buy one property. This could be difficult because regardless of where those properties are, maybe they're all over the US, maybe they're just here in Orange County, but maybe the markets may be different where each of these are located. So one or two may sell beautifully and maybe the third one couldn't.
Now, Debbie, you told me a story once of somebody that traded a whole bunch of properties into one property. That was kind of a big success story. Can you share that?
I would love that. So this gentleman had 9 properties in Newport Beach that he wanted to sell. And his goal in life was to go to he went to West Virginia and he bought a trout farm. And so what he did was some of these properties sold beautifully. And so we would hold these proceeds as each of these as each of these properties closed, those proceeds would come to us. We held them in his segregated account. But he had several in the end, maybe 4 that didn't close fast enough. And he had the trout farm already identified and he knew that's exactly what he wanted because he was going to turn it into a wedding venue, trout farm, cabins. He had this whole, vision for this property. So we did something called a hybrid exchange. And a hybrid exchange is part of the transaction as a forward exchange where the first few sold, but then there's the last few properties that didn't. So use the monies that we already had from the sale properties as the down payment for the trout farm. And then we turned it into the last ones we turned into a reverse exchange. So you can combine exchange tools. And it's amazing because at the end of the day, he was able to he got everything done, all his properties sold, and this amazing trout farm. And he still sends me pictures of what he's done with this property and how beautiful it is. And it just took a little strategy with how to use these different exchange tools to make this happen. It was beautiful.
Yeah, that's probably not the kind of deal you see every day, huh?
No, but every so often. And we laugh inside because we're like, wow. To me, that takes a lot of energy to do all this. And this guy, he had it. He really did. Mainly. But the most important thing is knowing the exchange tools, knowing how you can create a hybrid where it's a combination like forward, reverse, whatever, and making these work out right for the client. And it's amazing to see how it all can come together so beautifully.
Yeah, that's perfect. Now, do you see many 1031 exchanges fail? And what are some ways? We had talked about how if you don't identify in time, that it can fail. Have you seen other failures like that?
Okay, this is a few categories of. There's not a lot of failure, but I can tell you right up front that I can interpret. I can sort of assume something isn't going to work out right because of the following. Number one, we had a client, and I shared this with you at one time, that did a reverse exchange. And he had a property, just one property, Rancho Santa Margarita, he needed to sell. And he had an idea in his head of what that value of that property was going to be. And he wouldn't come off that value for anything. He wouldn't come down $10,000.
An unrealistic seller? I've never seen that in my whole career.
I know, what a surprise, right? And so he held out, convinced he was going to get the money, an offer for what he thought that, it should sell for. He wouldn't listen to his agent. It was horrible. His agent would call me and beg me to say, call him, see if you can get some sense in him, but no. So that exchange fell apart because behind that, you really need to listen to your real estate professional like Jordan. He knows the values. He'll give you, he'll do what he needs to do to figure out the right value. And even though we may have a number in our head, if we stick to that and not listen to our real estate professional, then we could end up blowing the whole deal. Because like Jordan, he knows his real estate and we need to trust them. And think about the other side. If you're making this exchange, doing this exchange to upgrade your portfolio, if you're going to miss out on $10,000 on here, you're ending up going to make up the $10,000 on what you're going to buy. So you got to look at the whole picture. Another idea of people that may not fail, that fail versus don't fail, is anybody that really works. I did a few years ago, I did some math on this, and I checked up all of our clients that worked in advance. I got an extension to this got a longer escrow period for their sale property and really was proactive in the beginning, the chances of them failing was like, the success rate was like 97%. It was amazing. Versus the people that thought, oh, I'll make this all happen. It'll be okay. We'll start when the property closes. And so they start in the 45 days. They don't do that advanced work. It was like an 80% success rate. So it dropped drastically.
Yeah.
And it might have been even lower because those are the ones that fall apart. Like, I got a vacation to do and I'll be back, and then I'm sure I'll find a house. Or I got to do this and I'll be back. You got to put the exchange. This is like 45 days out of your life of really working on it. Try to see if you can get it together. Find your replacement property and then go. Then go do what you need to do.
Yeah.
That, and then one more is that we talked about unrealistic values, delaying, and not being proactive. Those are the two.
So speaking of, being proactive, if you're thinking about kind of gearing up to do a 1031 exchange, whether, you've already sold your property and you got to find something, or hopefully you haven't even listed your property yet, you're in that planning process. What are some things you should be thinking of ahead of time to make sure that you have the highest chance of success with a 1031?
Okay. So one of them, like on the listing appointment, I always think this is really important. Like, Jordan, when you're on the listing appointment, look and make sure you understand who the real seller of this property is. Is it an entity? Is it an LLC? Is it some sort of entity, a C Corp, whatever? Because this could be problematic if there's multiple members, like to an LLC. So maybe there's 4 different parties to an LLC. None of them are related to each other. And everybody thinks once they sell it, in their heads, without communicating this to anybody, once they sell it, each of them can take their 25% and do what they want to do. And that's not true. Because from IRS's perspective, the LLC has been reporting this property. So the LLC is the owner, the LLC is the seller. The members aren't separated, can't separate out. So in our next session, we're going to talk about this on strategies and what to do. And that could really cause trouble, but there are strategies, but they don't realize it. So they have this idea and they get this property in contract, and then all of a sudden they start telling you, oh yeah, we're all going to go our separate way. That's what we need to figure out up front.
I see.
Another thing to figure out up front is don't waste time. Try to figure out exactly what you want to do. What type of properties you're interested in, what neighborhood, what city, what state. Figure that out so that you're not using your precious clock, just randomly trying to figure out pieces of real estate that may work. Have your plan figured out, because that way you're not wasting that time clock.
Yeah, that's a great point. So basically be prepared ahead of time, understand your entity. I think too, knowing, based on your example of the other guy who failed, know what you can realistically sell for. So what you're replacing, know what you can afford in finance, since you're going to be, usually you have to purchase, at or above the value of what you sold, right?
Exactly. And financing is important. Start early on that.
Yeah. So know the financing piece, and then identifying what and where, right? Because I guess you can, a lot of people that are 1031ing, especially maybe commercial or multifamily, if they're looking to, go out of state. I mean, that's a big venture to figure out, hey, where do I want to be, right?
Exactly.
And then what kind of asset class, right? Understanding is
exactly
industrial, multifamily, single family, important stuff. So be prepared, basically, right?
Exactly. And that's a nice formula to having a successful exchange. And it's really, in the end, that preparation time and effort that you did pays way off, because you're not scrambling and stressing yourself out with this, getting with the 45 days marching forward and not finding anything.
Yeah, absolutely. Out of curiosity, the guy with the Rancho Santa Margarita property, how much was he holding out for?
He was holding out for probably 50,000.
An extra 50,000. And what was the tax consequence of the failed exchange?
Oh, he had that property from the beginning. He was like original owner of one of those condos on the lake in Rancho Santa Margarita. And so he had a huge taxable event and he lost it all. So the reality was, could he have gotten that 50,000? His agent kept telling him, no, there's nothing, no comps, nothing to support that. So if you hear that, then it's time to reevaluate what, you're thinking in regards to the value. But he, and there were some upgrades and stuff, but he wouldn't even come down. Like if somebody gave him a $40,000, I mean, he wouldn't even come down 10,000. He was not reasonable about that price.
Yeah.
And it was a sad thing because he probably paid $150,000 taxes.
Jeez. Well, some great advice, Debbie. Really appreciate you doing this with us. This was super fun. I know when we kind of started talking through this and started, kind of brainstorming what direction we wanted to take it, we realized that there's a lot to 1031 exchanges. And so we kind of decided to split this into at least two separate webinars. And so we looks like our goal is to do our next one on November 19th at 11, which is about 4 weeks out from now, the week before Thanksgiving, to get kind of even more into the weeds, since today we kind of laid a foundation for the basics of 1031 exchanges. So next time we will go deeper into 1031 exchanges as they relate to death, divorce. I want to talk a little bit about, turning a primary residence into investment or the alternative, an investment into a primary. We'll get a little bit into reverse exchanges as well as Delaware statutory trusts and some other fun things like that.
Yay!
Yeah. So Debbie, you have been just so kind and generous with your time. If somebody needs to do a 1031 exchange, how do they find you?
Well, it wasn't in the Courtney posted in the chat room, because they can call me at my number 714-269-1285. And since we're in COVID, this is my work cell. So if I'm in my office or my home office, you'll be always able to get me on that number.
Fantastic.
And I think Courtney pays 714 exactly.
Okay.
And my office is right here in Mission Viejo. So I'm local.
Well, so Courtney put it in the chat. I know she'll put it on Facebook as well. And as we wrap up here, we're going to do a little bit of Q&A. So a question we have here, what is the fee to accomplish a 1031 exchange?
For a regular forward exchange, we charge a flat fee of $950. So it's $475 per property. That covers the sale property, the purchase property, and there are no other fees involved, unless they have more properties added to the exchange. And if you have, after that first set, if you say you're selling one to buy two, that second property, instead of $475, we charge $250 for any additional property.
Fantastic. Well, that's great to know. Do we have any? It doesn't look like we have any other questions. That means you were really thorough. Thank you very much, Debbie.
Well, thank you. It was a pleasure being here.
Yeah, I appreciate everybody being with us today. If you have any follow-up questions, feel free to reach out directly to Debbie or to me. We'd be happy to be a resource to you as when it comes to selling the first property, helping with the purchase of the upleg. I think coordinating those two takes definitely some finesse. So it takes a great team, and Debbie and I would both love to help. And hope everyone makes it a great rest of the week. Thank you.